Russia has recently experienced a significant decline in its crude oil exports, a development closely linked to the implementation of new U.S. sanctions. As these measures took effect in late October 2025, the volume of seaborne crude shipments from Russian ports dropped sharply. By early November, the 4-week average fell to 3.58 million barrels per day, marking the steepest decrease since January 2024. This downturn reflects both the immediate impact of the sanctions and the shifting dynamics in global energy markets. The timing and scale of the drop underscore the effectiveness of the sanctions in disrupting Russia's oil export flows. In October 2025, the United States implemented a new round of sanctions targeting major Russian oil companies, including industry giants Rosneft and Lukoil. These measures were designed to restrict Russia's ability to export crude oil by limiting transactions and access to international markets. As a result, key buyers such as China, India, and Turkey, who together account for the vast majority of Russia's seaborne crude exports, paused or reduced their purchases. This led to a sharp decline in Russian oil shipments, with volumes falling to their lowest levels since early 2024. The immediate market reaction was significant, as global oil prices surged by 5% following the announcement of the sanctions. The accumulation of unsold Russian oil at sea has further underscored the disruption caused by these actions, highlighting the far-reaching impact on both Russia's energy sector and the broader global market. Key buyers of Russian crude oil, including China, India, and Turkey, have responded swiftly to the recent U.S. sanctions by suspending or significantly reducing their purchases. These countries collectively account for about 95% of Russia's seaborne oil exports, making their actions particularly impactful. As a result of this pause in buying, Russian oil shipments have dropped sharply, and a substantial volume of unsold crude is now accumulating at sea. Reports indicate that more than 380 million barrels of Russian oil are currently stored on tankers, marking an 8% increase since early September. This buildup not only underscores the immediate effect of buyer hesitation, but also highlights the logistical challenges facing Russia's oil sector. The situation has introduced new uncertainties into global energy markets, with ripple effects on supply chains and pricing. The announcement of new U.S. sanctions against major Russian oil producers has triggered notable market repercussions. Global oil prices surged by 5% on October 23, 2025, immediately following the sanctions, reflecting heightened uncertainty among traders and buyers. This price spike underscores the significant role Russian crude exports play in stabilizing international energy markets. As shipments from Russia declined, concerns over supply shortages intensified, leading to increased volatility in oil trading. The accumulation of unsold Russian oil at sea further complicated market dynamics, with buyers pausing or reducing purchases amid fears of secondary sanctions. Overall, these developments have contributed to a more unpredictable and sensitive global oil market environment. In response to the recent U.S. sanctions, Russian oil companies have begun to implement significant strategic shifts. Lukoil, one of the country's largest producers, has announced plans to sell its international assets, aiming to complete these transactions within the sanctions grace period, which ends on November 21st. Negotiations are underway, with the possibility of an extension if necessary. These moves reflect the broader challenges facing Russia's energy sector, as major buyers like China and India pause or reduce their purchases. The accumulation of unsold oil at sea and heightened market volatility underscore the far-reaching impact of these sanctions. As Russian firms adapt, the sector faces uncertainty regarding future exports, investment, and global market positioning.